The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to more Market Insights. Today we're breaking down the key forces shaping markets right now, from November's volatility and the upcoming Fed meeting to what investors should watch as we head into year-end in 2026. So there's a lot of speculation, conflicting forecasts, and of course shifting expectations. So we're going to cut through the noise and get a clear read on what is really happening and what really matters. And joining me as always, Andy Moore, Quantum's Vice President of Advanced Planning and Portfolio Solutions. So markets have finally shown a lot of volatility in November after, gains of like 7 months. And there was sort of a healthy correction, if I'm not wrong. What stood out on that, and then why is Bitcoin a factor in all this?
Happy Thanksgiving. Hope you and the family had a good one over the long weekend. And I think you're right. I think the markets finally had a little bit of a pullback, 5 to 7%, depending on the markets. I think a lot of it was overdue, but then you have the headlines in the media. If there was one main factor, I would say it was the Fed dot plot on the expectations. So if you looked at the headlines, there's a lot of potential for the Fed to skip a December rate cut and maybe push it into 2026. When we started the month, it had dropped to about 30% on that probability. By Friday, we were back at 85%. So I think the key thing that the Fed is probably looking at, and you and I talked last month that I thought they were going to cut in December. And with the government shutdown, we had a lot of data that hadn't been released, which is, I think, why you saw the pullback in expectations. But I think the labor market has to be a concern for the Fed. So with that said, I think they cut in January, which is next week. The 9th and the 10th is the Fed meeting. But when we look at the overall correction in November, I think it was healthy. We got to buy the dip in the month end. We did have a couple streaks extend and one broken. So the NASDAQ had been up 7 straight months. That streak broke. We were down 1.5%. S&P, Russell, and the Dow all made positive gains. So that's 7 months in a row for them. Going into December here, we'll see what happens. I think there's some volatility beginning of the month, the front end, and then we get into the Santa Claus rally at the end. The one thing that I did notice looking at some of the statistics yesterday, when I looked at the beginning of the month, we talked about this in November podcast, the breadth on the Russell 3000 was getting pretty negative. We're about 40% of all stocks were below the 20-day moving average. As of this morning, over 70% were back above, which is a higher number than when the S&P was at all-time highs. So I think from a breadth consideration, it's gotten a lot better. And the other contrarian indicator I love to watch is market sentiment, and it fell through the floor in November. Usually a contrarian indicator. So when everyone hates the market, you got to love to buy it. So
and that's with all those gains too. But the market sentiment is still, conservative in one sense, right?
It's been almost bearish the last 6 months. When we actually got into end of October, it had flipped to a bullish sentiment, which you and I almost discuss every single month. And then end of November, it again fell through the floor as we got that correction in the market. So I always use that as a contrarian indicator. The other point that you made was Bitcoin. I've used Bitcoin now for a while as almost a lead-in indicator for some of the money that I manage. And if you look at Bitcoin, it usually leads the broader markets, the S&P, NASDAQ, we'll call it, which is a little bit more of a higher volatile index with all the technology stocks. But it usually leads by 3, 4, 5, 6 weeks. And we had Bitcoin top early October. S&P topped late October. And then we just recently had a really bad month for Bitcoin. So we're down almost 40% from the highs. I see we're down again today as we're recording this. But I would use that as an indicator to see if that can stage a rally in the year end. If so, I think the equity markets can follow. But I think underneath the surface, it could be maybe some early indications of what may come first quarter next year.
So let's go back to the Fed. So now an 80% chance of a rate cut by the end of the year. Why are they concerned about the labor market? Is that why they're going in this direction? And how important is the wording in this meeting?
They haven't come out specifically and identified the labor market. There's been a couple hints from some of the Fed governors, but I do think that's got to be the one thing that would keep them up at night and worried that they may be behind the eight ball, which you and I have discussed. I think they are. When the labor market weakens, and Goldman Sachs did a really good study on this, it's hard to reverse that slide. And with the advancements in technology and AI, you've seen a lot of these big tech companies laying employees off. You have the government, when Trump took office, at early retirement packages and the layoffs there. So, we have seen the unemployment number tick up from the mid threes to the low fours here. So I do think that's got to be a concern for them, and probably the main reason I would think they would cut in December, even with the lack of visibility in some of the data. We're not going to get CPI and PPI reports till after the Fed meets. We'll get some PCE reports later this week, but I think that's the main reason, in my opinion, that you'll see the rate cut. And the language is going to be key, because look at what happened in November when we went to a 30% probability that the Fed wasn't going to cut, or the Fed was going to cut in December. We sell off 5 to 7%. Probably not the main catalyst. We had 7 straight months of gains. It's probably an excuse for the healthy correction. But the language is going to be key, and I think that's what you look for going into 2026. Right now, the Fed dot plot is only right around 2.5, 2.7, I think, rate cuts next year. We'll see if that's accurate. I think it probably will be more than that if they do delay and they run into problems going in the second half of the year.
And Trump is naming a new Fed chair. So what does that mean for 2026? And would that affect anything? Because I would say if they hold off on rate cuts, you've talked about a potential another correction or something worse. But a new Fed chair, what does that mean for everything?
So it sounds like over the weekend he did make a decision. He just hasn't announced it yet. Yeah. The person that he picks is going to be very accommodated to Trump policy. But you got to keep in mind, he won't get anointed chairman until May or June. I believe it's May, and then June he probably gets confirmed. I believe the time frame. I may be off, but so you still have basically the first half of the year of a Powell overseeing the Fed governors and what they're going to be doing. So we're still a good 6-7 months away from whom Trump is going to pick, but it will be someone that's very favorable to his policy.
And then let's talk about as goes January. There goes the market that goes back to 1950. What are some of the indicators that you're watching? Including a Santa Claus rally. What do we expect here?
So I do think you see choppiness the first couple of weeks, and there's a couple of reasons that historically, having been an advisor and portfolio manager, you got tax loss harvesting that's going to go on. Typically, we start to see markets rally in the year end. Typically, we'll call it December 15th. You'll see some window dressing from fund managers that are underperforming benchmarks, so they have to go start buying probably the Mag 7, the Mag 10 stocks to put in the portfolio. But then, there's 3 indicators, and this goes back to the Stock Traders Almanac that I like to quote that are out there. The Santa Claus rally, which will start December 24th in the year end. We kind of had the same thing for Thanksgiving, right? We rallied 5 straight days going into Thanksgiving. The first 5 days of January, and then January as a whole is a barometer. And you just quoted it. Since 1950, as goes January, typically goes the market. If we're down in January, that is either a large correction or the start of a bear market. But those 3 indicators, if you get the trifecta, all 3 are positive. I believe it's almost a 90% probability of the market's higher in 2026. I think there's some other obstacles out there. When we look at, kind of the correction that we just saw, we had a lot of advisors. We've talked about that S&P 8,000 white paper that I wrote. We've had advisors, firms call requests that. It's obviously our content, but they can put their name and phone number on it. But as soon as you see that 5% correction, and clients that have been used to these bull markets start calling advisors, asking what's going on. And a perfect example is my father. Right? He's 78 years old. Market's down 4 or 5%. He starts calling and asking what's going on. And that's my dad. Imagine if it was someone that I'm not related to, i.e., the advisors that are out there. So. That's still 20% bonuses, 13% bonuses. You can sell these asset classes higher. If we do pull back in 2026, let's say we have a healthy 20% correction. There's a couple of products that have a 10% free partial withdrawal and original premium. So I put $1 million in, I'm going to get $200,000 in cash bonus, and then I can take $100,000 a year every year, cumulative up to $300,000 on that, and dollar cost average back into the market. So. It's funny just how a little blip in the market will get advisors calling and clients like my father, calling me to ask what's going on.
Well, I mean, the S&P targets for 2026 are all over the place. I mean, 4,300, 7,300, 8,000, along with the white paper. With this wide dispersion, what should investors be thinking about? And obviously, using the product as a hedge against that. But what should they be watching as well?
So we've talked about this a lot, and we use the partnership with the Index Standard and Lawrence Black, and that's always a 10-year forecast projection. Wall Street is really good at the longer-term forecasts. Right. They're so on the short-term forecast. The most that I've seen, they're not all out yet, are somewhere between that 7,300 and 7,500. There's a couple that are at around 8,000. That's a really bullish case scenario. I just saw Evercore. They're at 9,000. They put that at a 25% probability. Smaller odds, but and it's still all around the AI narrative and advancements in the technology, which I think 9,000 is a huge stretch, but you can't ever rule anything out for next year. But when we look at the limited upside, I'd say 73 to 7,500. There's a bear case out there at 4,300. I still think if you're an advisor with clients that are in retirement or close to retirement, we've had a really, really good bull market since the financial crisis, couple hiccups and healthy corrections, a small dual bear market in 2022. You reallocate, de-risk. The one thing that which is gonna hurt us as an industry is the rate cuts that the Fed are doing. Right now, we still have really good income products, right? They're probably 30, 40, 50% higher than they were, back when interest rates were down near zero. So you should take advantage of that to get the full Social Security or core expenses in retirement. The bonus products we just talked about, S&P 8,000, take advantage of bonuses and dollar cost average opportunities back into the AUM side. But as rates get cut, that affects us because we're interest rate sensitive with the insurance companies in their general account. We've seen rate cut after rate cut on participation rates and caps on the indices. Income will probably be next, bonuses are next. So as the Fed lowers rates in December, probably you'll see another round of rate cuts going into early next year. So you need to take advantage of it now, especially if your father or mother called you last week and want to know what's going on. The same thing's happening with advisors and clients right now.
He's Andy Moore, Quantum's Vice President of Advanced Planning and Portfolio Solutions. This is a podcast that we do on a monthly basis, and sometimes even sooner when things happening in the market and the economy warrant it. But check it out, and if you'd ever like to talk to Andy, he's available. Give us a call here at Quantum, and thanks for watching.